Hi investors, and today I will examine around 30 key charts that illustrate the current state of markets and the economy in 2024. These charts offer valuable insights for both novice and experienced investors. By the end of this video, you'll be dropping economic truth bombs like a seasoned pro at your next dinner party. We will be decoding the DNA of economy and unraveling the mysterious that keep Wall Street titans up at night. First chart, inflation trend. This chart from JP Morgan Asset Management shows inflation is expected to continue its gradual decline, potentially reaching the Federal Reserve's 2% target by mid-2025. This trend suggests we might see interest rate cuts later this year, which could stimulate economic growth and boost stock prices that we want. Labor market normalization is the second chart, and Goldman Sachs provides this chart, showing how job openings and unemployment rates have changed. We've moved from the unusual post-pandemic situation back towards more normal levels. This normalization has happened without major disruptions, which is good news for the economy. Chart 3. Housing market inflation. This chart highlights a significant drop in primary rents and owners' equivalent rents. Housing costs are a major component of inflation, so this decline could accelerate the overall decrease in inflation. It's a promising sign for those hoping to see lower inflation numbers soon. 4. Government spending impact. Bank of America Securities shows how government spending has boosted economic growth. However, this effect is expected to diminish over time. As this fiscal stimulus fades, we might see slower economic growth and potentially lower inflation in the coming months. Chart 5. Labor market indicators. These two charts from Dynamic Economic Strategy supports the argument for interest rate cuts. They show labor market conditions easing, which could give the Federal Reserve more confidence to lower rates, possibly as soon as September. Chart 6. S&P performance. Charles Schwab's chart reveals an unusual situation. A historically low percentage of S&P 500 stocks have outperformed the index itself. This suggests the market's gains have been concentrated in a small number of stocks, particularly in the tech sector. However, these are signs of rotation into smaller stocks, which could broaden the market rally. Chart 7. AI investment confidence. For sure, Goldman Sachs provides this chart showing strong investor confidence in AI-related infrastructure investment. However, the flat performance of other sectors suggests investors are still uncertain about AI's broader economic impacts. Chart 8. Market volatility. Data track research chart of the VIX index, often called the fear index, shows low expected market volatility. This is typical of bull markets and suggests investors are currently feeling confident about market conditions. Chart 9. Market expectations. Citi Research's chart indicates that market expectations for company fundamentals are high. This means we need to see strong earnings results and positive future guidance from companies to support current market levels or push them even higher. Chart 10. Large versus small stocks. Richard Bernstein Advisors shows an unusual trend. Large cap stocks are outperforming smaller stocks, despite credit spreads narrowing. Typically, we'd expect the opposite. This unusual relationship might present opportunities for investors looking at different market segments. Chart 11. Russell 2000 performance. Bespoke Investment Group's chart shows the Russell 2000 index, which tracks smaller companies, recently closed at a record high compared to its 50-day moving average. This indicates very strong recent performance in smaller stocks, which could be a sign of broadening market strength. Chart 12. AI and hot topic green energy investment. So BlackRock Investment Institute predicts significant investments in AI and the low carbon transitions. These investments could happen faster than previous technological revolutions, potentially transforming economies and markets in the near future. We heard it before. Chart 13. Inventory cycle. This Bank of America Securities shows that the sharp inventory contraction we've seen is starting to moderate. This suggests the destocking cycle might be ending, which could be positive for economic growth in the coming quarters. Chart 14, bond yields. Schwab Center for Financial Research chart highlights opportunities in the bond market also. Investors can potentially build portfolios with yields of 5% or more over the next 5 to 10 years without taking significant credit risk. Chart 15 shows election impact on inflation. Oxford Economics predicts that regardless of the election outcome, government policies are likely to add to inflation. The impact could be most significant if there is a Republican sweep, potentially leading to tax cuts, higher defense spending, and increased tariffs. 16 chart, political impact on investments. This chart from CARE shows the long-term performance of a 10,000 investment in the S&P 500 under different political scenarios. The key takeaway? Staying invested, regardless of which party is in power, has historically provided the best returns. Who could think? Chart 17, government debt. UBS Investment Bank's chart shows how changes in government debt issues have affected bond yields. The shift towards more short-term debt could have implications for long-term interest rates and the sustainability of large deficits. Chart 18, labor market normalization. Yardeni research suggests the labor market is normalizing post-pandemic. They attribute the rise in unemployment to increased immigration and growing labor force, rather than recessionary pressures. 19 chart, job turnover. Jeffrey's chart shows job turnover is slowing. The Great Resignation has transitioned to the big stay. This could lead to improved productivity and help cool inflation further. Chart 20, consumer spending. Wells Fargo Economics highlights that there has never been a recession without a year-over-year decline in real discretionary spending. Current spending habits show consumers becoming more selective as purchasing power fades. 21 chart, income versus inflation. Carson Group's chart reveals that disposable incomes and employee compensation have increased more than overall inflation since the pandemic started. This suggests consumers are in a relatively good position despite inflationary pressures. Consumer spending, chart 22. Sam Consulting shows that consumer spending, even adjusted for inflation, has risen solidly in recent years and is near its pre-COVID trend. This resilience in consumer spending is remarkable and crucial for economic stability. 23 chart, job-changing benefits. Bank of America again Institute's chart indicates that changing jobs may not be as financially rewarding as it used to be. The rate of workers changing jobs has declined, and those who do switch are getting smaller pay increase from their new employers. Chart 24, remote work impact. ADP research here highlights how the normalization of remote work has created a thicker job market. This means a greater variety of both jobs and candidates are available, potentially leading to better matches between employers and employees. Chart 25. Earnings forecasts. Deutsche Bank's chart shows analyst consensus and their own earnings forecasts. Both predict continued solid earnings growth. This could potentially drive further upside for equities by year end. Again, chart 26, rate cut expectation. Ritholtz Wealth Management suggests upcoming rate cuts might be celebratory, occurring because the Fed believes they have inflation under control, rather than due to economic troubles. 27. Tech stock valuation. Invesco's chart shows the current PE ratio of the Nasdaq 100 is higher than historical average, but not at extreme levels. This suggests tech stocks might not be as sensitive to rate cuts as in the past. Chart 28. Economic backdrop. Piper Sandler describes the current environment as Goldilocks, softening economic activity with moderating inflation. This could provide room for the Fed to cut rates, potentially supporting the stock market again. Market pullbacks expectation, chart 29. BMO Capital Markets expects that if a more severe market pullback occurs this year, it will likely happen at higher index levels than previously anticipated. 30-chart historical market performance. 2A, if I'm not mistaken, chart shows that in years where the S&P 500 gained more than 10% in the first half, like 2024, the market has historically continued to rise in the second half in 24, out of 27 such periods. So what is conclusion here? Too optimistic there. But that concludes my overview of these key charts explaining the economy and markets in 2024. Remember, while these trends are informative, they are just part of the picture. Always do your own research or consult with a financial advisor before making investment decisions, as you know. And you can see my performance as the portfolio manager who's beating S&P 500 here. Thanks you for watching, and don't forget to press the like button.